Which of the following best describes the role of common law in New Zealand's insurance legal framework? A. It sets out statutory requirements insurers must follow. B. It provides discretionary guidelines that insurers may adopt. C. It interprets and supplements statutory law through judicial decisions. D. It overrides the Insurance Law Reform Acts when in conflict. The correct answer is C. It interprets and supplements statutory law through judicial decisions. Explanation. Common law in New Zealand consists of legal principles developed through decisions of the courts. In insurance, it plays a key role in interpreting statutes like the Insurance Law Reform Acts 1977 and 1985 and fills in legal gaps not addressed by legislation. It does not override statutory law but alongside it unless otherwise legislated. Under the Insurance Law Reform Act 1977, what happens if an insured omits to disclose a material fact unknowingly? A. The contract is automatically void. B. The insurer has no legal recourse. C. The insurer may avoid the contract only if non-disclosure was intentional. D. The insurer may avoid the contract if the omission induced the contract. The correct answer is D. The insurer may avoid the contract if the omission induced the contract. Explanation. Under the Insurance Law Reform Act 1977, even if non-disclosure was innocent or unintentional, the insurer can avoid the policy only if it can prove it was induced to enter the contract and would not have done so if full disclosure had been made. Which of the following is not a requirement for forming a valid insurance contract under New Zealand law? A. Offer and acceptance. B. Intention to create legal relations. C. Written consent from the Reserve Bank. D. Consideration. The correct answer is C. Written consent from the Reserve Bank. Explanation. The key elements of a valid insurance contract include offer and acceptance, intention to create legal relations, and consideration. Consent from the Reserve Bank is not required for private insurance contracts, although the Reserve Bank does regulate insurers under the Insurance Prudential Supervision Act 2010. What is the consequence under the Contract and Commercial Law Act 2017 if a misrepresentation is found to have occurred during pre-contract disclosure? A. The insured must pay a penalty to the FMA. B. The contract becomes illegal. C. The misrepresentation may render the contract voidable. D. The insurer is obligated to maintain the contract. The correct answer is C. The misrepresentation may render the contract voidable. Explanation. Under the Contract and Commercial Law Act 2017, if a misrepresentation is material and induced the other party to enter into the contract, the affected party, often the insurer, may void the contract or seek damages. This reinforces the duty of utmost good faith in insurance. Which of the following best describes a broker's fiduciary duty under New Zealand law? A. To act in the insurer's best financial interest. B. To act as legal representative in court disputes. C. To act impartially between insurer and client. D. To prioritize the client's best interest above their own. The correct answer is D. To prioritize the client's best interest above their own. Explanation. A fiduciary duty is a legal obligation of one party to act in the best interest of another. Insurance brokers in NZ owe this duty to their clients, which includes acting with care, loyalty, honesty, and avoiding conflicts of interest. They are not legal representatives in court unless qualified separately. What is the primary purpose of the Financial Markets Conduct Act 2013 in relation to insurance intermediaries? A. To govern cross-border insurance treaty arrangements. B. To prescribe criminal penalties for fraud. C. To regulate the Reserve Bank solvency requirements. D. To regulate conduct, disclosure, and licensing of financial service providers. The correct answer is D. To regulate conduct, disclosure, and licensing of financial service providers. Explanation. The Financial Markets Conduct Act 2013 (FCA) aims to protect consumers and promote confident participation in financial markets. It regulates the behavior of insurance intermediaries through disclosure obligations, fair dealing requirements, and licensing regimes primarily enforced by the Financial Authority (FMA). A broker acts as an agent for A. The courts in disputed claims. B. The Reserve Bank under statutory regulation. C. The client, unless expressly agreed otherwise. D. Only the insurer in all cases. The correct answer is C. The client, unless expressly agreed otherwise. Explanation. In NZ insurance law, a broker generally acts as an agent of the client, not the insurer, unless a contract or specific conduct creates an agency relationship with the insurer. This distinction is crucial in determining where liability and obligations lie. Which principle requires full disclosure of all material facts by the insured to the insurer? A. Indemnity. B. Subrogation. C. Utmost good faith. D. Proximate cause. The correct answer is C. Utmost good faith explanation. The principle of utmost good faith, uberrima fides, requires both parties, especially the insured, to disclose all material facts that could affect the insurer's decision to accept the risk or set the terms. Failure can result in the contract being voided. What is considered a material fact in the context of pre-contract disclosure? A. A fact that relates only to the payment method of premiums. B. A fact only the client considers personally relevant. C. Any fact that affects the broker's commission. D. A fact that a reasonable insurer would consider important when deciding to insure. The correct answer is D. A fact that a reasonable insurer would consider important when deciding to insure. Explanation. A material fact is one that would influence the judgment of a prudent insurer in deciding whether to accept the risk and on what terms. The client's perception is irrelevant. What matters is its impact on the insurer's decision-making. In what situation can a broker face legal liability under the concept of negligence? A. Failing to increase premiums on the insurer's behalf. B. Failing to inform the client of a material exclusion in the policy. C. Declining to represent both parties in a contract. D. Selling a policy with lower commission. The correct answer is B. Failing to inform the client of a material exclusion in the policy. Explanation. If a broker fails to disclose important policy terms such as exclusions, they can be held negligent for breaching their duty of care. Clients rely on brokers for professional advice, and errors can result in financial loss or denied claims, leading to legal liability. Which regulatory body is primarily responsible for licensing financial advice providers in New Zealand? A. Reserve Bank of New Zealand. B. Ministry of Business, Innovation and Employment, MBA. C. Financial Markets Authority, FMA. D. Insurance and Financial Services Ombudsman, IFSO. The correct answer is C. Financial Markets Authority, FMA. Explanation. The Financial Markets Authority, FMA, is the primary regulator overseeing financial markets and financial services in New Zealand. Under the Financial Markets Conduct Act 2013, the FMA licenses financial advice providers and ensures that brokers operate within the legal and ethical boundaries defined by the law. Under the Financial Service Providers Registration and Dispute Resolution Act 2008, what is a key requirement for all financial service providers? A. They must be members of a professional body. B. They must register on the Financial Service Providers Register, FPR. C. They must only sell government guaranteed products. D. They must operate as independent advisors. The correct answer is B. They must register on the Financial Service Providers Register, FPR. Explanation. The Financial Service Providers Registration and Dispute Resolution Act 2008 requires all individuals and entities providing financial services in New Zealand to register on the Financial Service Providers Register, FPR. This registration ensures transparency and allows consumers to verify provider legitimacy. Which of the following is a breach of the Privacy Act 2020 by an insurance broker? A. Retaining client data for 7 years. B. Sharing personal client information without consent. C. Encrypting client data. D. Informing clients about data usage policies. The correct answer is B. Sharing personal client information without consent. Explanation. Under the Privacy Act 2020, insurance brokers must not disclose personal information without the individual's consent unless permitted by law. Sharing such information without consent constitutes breach, which can lead to penalties or enforcement actions by the Privacy Commissioner. The Code of Professional Conduct for Financial Advice Services requires financial advisors to A. Provide free advice to all clients. B. Act in the client's best interests. C. Guarantee investment returns. D. Avoid disclosing their fees. The correct answer is B. Act in the client's best interests. Explanation. One of the central duties under the Code of Professional Conduct for Financial Advice Services is to give priority to the client's interests and act with integrity and care. Advisors must provide advice that is suitable and puts the client's financial well-being ahead of personal or business interests. Which act makes it illegal to engage in misleading or deceptive conduct in the promotion of insurance products? A. Insurance Contracts Act 2020. B. Consumer Guarantees Act 1993. C. Fair Trading Act 1986. D. Companies Act 1993. The correct answer is C. Fair Trading Act 1986. Explanation. The Fair Trading Act 1986 prohibits misleading or deceptive conduct, false representations, and unsubstantiated claims in trade. Insurance brokers must ensure that all advertising and advice about insurance products is truthful and not likely to mislead consumers. What is the maximum penalty the Privacy Commissioner can impose for serious privacy breaches under the Privacy Act 2020? A. $1,000. B. $10,000. C. $50,000. D. $10 million. The correct answer is C. $50,000. Explanation. The Privacy Act 2020 gives the Human Rights Review Tribunal authority to award damages of up to $50,000 for breaches of privacy, including emotional harm and humiliation resulting from mishandling personal information. Which of the following scenarios is an example of a false representation under the Fair Trading Act 1986? A. Saying, a policy includes flood cover when it doesn't. B. Accidentally misfiling client's paperwork. C. Charging higher fee for urgent service. D. Asking client to provide identification. The correct answer is A. Saying, a policy includes flood cover when it doesn't. Explanation. False representations involve making statements that are untrue or misleading about product or service. Claiming that an insurance policy covers flood damage when it does not is breach of the Fair Trading Act 1986. A client believes their broker breached the Code of Professional Conduct. Who investigates such breaches? A. Reserve Bank of New Zealand. B. Financial Service Providers Register FPR. C. Financial Markets Authority FMA. D. New Zealand Law Society. The correct answer is C. Financial Markets Authority FMA. Explanation. The FMA oversees compliance with the Code of Professional Conduct for financial advice services that investigates complaints and can take enforcement actions if the broker fails to meet the standards of competence, ethical behavior, or care. What must brokers do under the Privacy Act 2020 before collecting personal information? A. Notify the government. B. Get written permission from the Privacy Commissioner. C. Inform the individual about the purpose of collection. D. Encrypt the data immediately. The correct answer is C. Inform the individual about the purpose of collection. Explanation. Under Information Privacy Principle 3 (IP) of the Privacy Act 2020, brokers must inform individuals about why their personal data is being collected, who will receive it, and their rights to access and correct it. Which of the following is not a licensing requirement under the Financial Markets Conduct Act (FMC Act) for financial advice providers? A. Demonstrate financial capability. B. Operate under a dispute resolution scheme. C. Be a member of a political association. D. Meet compliance obligations. The correct answer is C. B. A member of a political association. Explanation. The FMC requires financial advice providers to be licensed, meet fit and proper person tests, operate under a dispute resolution scheme, and comply with specific reporting and conduct obligations. There is no requirement to belong to any political organization. What is the main purpose of a dispute resolution scheme (DRS) under New Zealand law? A. To represent insurance brokers in legal disputes. B. To provide free, independent resolution for client complaints against financial service providers. C. To determine the broker's liability in criminal cases. D. To regulate broker commissions and sales incentives. The correct answer is B. To provide free, independent resolution for client complaints against financial service providers. Explanation. Arrays required under the Financial Service Providers Registration and Dispute Resolution Act 2008 to ensure clients have access to independent, free dispute resolution. Brokers must belong to a scheme such as SEL, or if so, what is the role of the Ombudsman in New Zealand's financial dispute resolution process? A. To provide legal advice to insurance brokers. B. To represent the government in industry regulation. C. To independently assess and help resolve client complaints against financial providers. D. To oversee insurance product pricing. The correct answer is C, to independently assess and help resolve client complaints against financial providers. Explanation. The Ombudsman, such as the Insurance and Financial Services Ombudsman, if so, offers an impartial and independent review when disputes cannot be resolved through a firm's internal process. What is the first step a client should take when they have a complaint about an insurance broker? A. Contact the Financial Markets Authority directly. B. Submit a complaint to the dispute resolution scheme. C. Take the matter to court. D. Raise the complaint through the broker's internal complaints process. The correct answer is D. Raise the complaint through the broker's internal complaints process. Explanation. The internal complaints process is the first channel client must use. If it fails to resolve the issue, only then may the client approach DRS-ICL, or if so, as required by law. Under the Amok Act 2009, what must insurance brokers do when they detect suspicious activity? A. Cancel the client's insurance policy immediately. B. Report it to the Financial Markets Authority, FMA. C. File suspicious activity report, SAR, with the Financial Intelligence Unit, FIU. D. Notify the client and advise them to stop the activity. The correct answer is C. File a suspicious activity report, SAR, with the Financial Intelligence Unit, FIU. Explanation. Brokers must file a SAR when they suspect activities related to money laundering or terrorism financing. The FIU, part of the NZ Police, handles these reports under the Amok Act 2009. What is a key feature of the risk-based approach in Amok compliance? A. Every client must be treated equally regardless of risk. B. High-risk clients must be ignored to avoid liability. C. The level of due diligence depends on the risk level of the client or transaction. D. Brokers must always seek police assistance before verifying identity. The correct answer is C. The level of due diligence depends on the risk level of the client or transaction. Explanation. The risk-based approach allows brokers to tailor customer due diligence according to assessed risks. More extensive checks for higher-risk customers or activities. Which of the following is not a requirement under the Amok Act for insurance brokers? A. Keeping records of client transactions. B. Submitting quarterly income reports to the FMA. C. Verifying client identities before transacting. D. Reporting suspicious activity to authorities. The correct answer is B. Submitting quarterly income reports to the FMA. Explanation. Brokers are not obligated to submit income reports to the FMA under Amok rules. Their obligations focus on customer due diligence, reporting suspicious activity, and maintaining compliance records. What role does the Insurance Brokers Association of New Zealand (IBANS) play in the industry? A. Issues insurance policies to clients. B. It functions as a dispute resolution scheme. C. It sets ethical and professional standards for its members. D. It regulates insurance premiums across New Zealand. The correct answer is C. It sets ethical and professional standards for its members. Explanation. IBANS is a voluntary industry body that promotes professionalism and high ethical standards through education, advocacy, and support for its broker members. What is one consequence of a broker breaching the Code of Professional Conduct for Financial Advice Services? A. Disciplinary action by the Financial Markets Authority, FMA. B. Immediate loss of all existing clients. C. Temporary exemption from Amok reporting. D. Eligibility for higher commissions. The correct answer is A. Disciplinary action by the Financial Markets Authority, FMA. Explanation. A breach of the Code of Professional Conduct may result in FMA enforced disciplinary action such as suspension or cancellation of a broker's license. The code is designed to uphold high standards of integrity, competence, and ethical behavior. What ethical consideration should a broker prioritize when advising a vulnerable client? A. Acting in the client's best interests with clear and understandable communication. B. Only offering products with the highest commissions. C. Encouraging fast decisions to close the deal. D. Maximizing premium sales. The correct answer is A. Acting in the client's best interests with clear and understandable communication. Explanation. Ethical standards require that brokers act in the best interest of clients, particularly vulnerable ones, by ensuring clarity, transparency, and suitability of advice. Vulnerable clients may need additional support due to age, mental capacity, or language barriers. What does professional misconduct in insurance broking typically include? A. Referring clients to dispute resolution scheme. B. Offering discounts to clients. C. Failing to disclose conflict of interest or misrepresenting policy. D. Providing legally sound advice. The correct answer is C. Failing to disclose a conflict of interest or misrepresenting a policy explanation. Professional misconduct involves unethical behavior such as concealing conflicts of interest, giving misleading advice, or violating industry codes. These actions undermine trust and may result in complaints or regulatory penalties.